Hey guys, Freaky Finance here. I'm gonna try to film this today on Sunday, and maybe I'll put it out on New Year's or New Year's Day, New Year's Eve. Um, but kind of during the last video, I kind of thought that maybe I should do some trade overviews for the year and kind of the good ones and the bad ones. I know a lot of people on YouTube and stuff like that. They kind of always kind of show themselves in a good light, right? And so what I want to do with this video is an honest reflection of things, and also for me, because again, this channel, I haven't made any money from YouTube, right? So all I do is try to be right with the stock market. I don't try to sell any courses or anything. I'm not trying to say I'm a pro. These are literally just thoughts that I have, and I just share them, and it helps me when I go back in time to learn, right? And it's definitely helped me over the years in terms of avoiding similar mistakes, or at least recognizing a pattern over time, because you still will make the same mistake a few times, probably. At least I will, because I can be very stubborn. So anyway, first good trade of the year, and these are in no specific order, they're just kind of ones I pulled off. Why Tesla? So that's Tesla on the Canadian side. It's basically, I started familiarizing with myself with it. You can see the buy here, 48 on Monday, October 21st, right before the election. Part of that was near the end of, you can see this October 21st. So these are all a bunch of trades. Started getting filled on the Bank of Nova Scotia side. Then I started transferring money over to Wealthsimple just because I was trading more and the fees are way better. So yeah, it's not even comparative like the banks versus Wealthsimple in Canada anyway. It's just far superior for me. So this is kind of what my trades look like, is I'll start a small position and I'll slowly average in as I get more confident, as I get more information, as I feel like I know what's going on better. Because the first time you look at it, like, I pretend to be the smartest person in the world. Honestly, I'm just trying to think this could be a good idea that has this, this, and this that I look for, and then if it does, I'm probably going to buy it if I think there's something there. So with Tesla, you can see me buying a little bit at 19, a little bit again, 18, right? And this is within 2 weeks. Again, another 2 weeks, another 30, another day, another 30, right? And I'm just averaging down, right? It goes all the way from 18 or 1950 to 17 in very short order, right? So basically you're taking 2 months of losses, just averaging it slowly over time. As I see the next quarter, I see what they're saying, I kind of get, is this actually bottoming or not? Right? Because these are not points in time, it's kind of like a process, right? And this just helps me. I'm never going to get the timing right. I'm just trying to be more likely or not going to be right, right? So that's kind of how I trade. So all these, I'm only showing one trade, but this is actually behind what's actually happening is me slowly averaging or slowly averaging out. So anyway, why Tesla? Why did it work out? Partially because this was more of an election thing. I started looking at companies that were likely to win if Trump was elected, and Tesla was one that was up there and was currently already trading relatively cheap to its historical average in the recent four years. Not cheap relative to anything else, relative to itself, right? It was already down 50% or something like that. So, and I was like, okay, this could be one that might rally. So that's all it was. There wasn't, and well, on the fundamental side, Tesla already had a really bad decel in terms of production and deliveries, but a lot of it, they chewed through a lot of the inventory overhang with that, so we should see less margin pressure than we have in the past. I've also seen a lot of things with the legacy automakers continue to struggle to make decisions, very slow to respond to Tesla. At this point, they're just not doing anything fast enough. And I know that because I own Mobileye, which we talked about on the channel before, right? And that's the only obvious one for these automakers that don't want to go with Tesla. They're probably going to have to do their own thing, and it's going to be through Mobileye, I think. So that's just my opinion. And they're very slow to respond. So if Mobileye is struggling, that means all the auto manufacturers are being slow, which means autonomous driving is going to landslide more, even a Tesla, more than it has. And then you have like actual cost saving structures because Tesla doesn't need to market the same way the legacy automakers do. They spend a lot less in marketing. Part of that is the Elon effect as a figurehead. It just saves a lot more in terms of marketing. People know what he is, what he stands for. They don't need to get the word out. He literally gets it out every day on Twitter when he's spamming my feed some days, right? So that's actually a big cost savings. And more importantly, longer term, obviously the market's not pricing in Tesla as an automaker, right? You would never own it right now. So that's Actually, one of the things, right, I'm starting to sell it now, right, after the rally, after it goes up 80 or 100% in a very short amount of time. I usually, almost always, will trim some. Some people will say that's bad, trimming your winners. I have learned over time that it's prudent because it sets up the other things that I can buy. It's not like a binary play. Everything's shades of gray. But in my experience, when something goes up really quickly, I usually take proceeds out. And then we just wait till the next call, the next quarter, and we just go through it all again. That's just my opinions that of what I've learned over time. It's just helped me. It also helps me risk manage the position, helps me emotionally, right? So I'm not all of a sudden have 20% of my portfolio in one company, right? Which would be too much for me, at least in terms of Tesla, right? I would be confident right now at this price to have 20% of my money in Tesla, right? But I have wrote it a few times, like we wrote it through Solar City and stuff like that. So I am comfortable with the name, and Tesla, I mean, if anyone, like a lot of people just own Tesla, right? Because they've been rewarded so well for it. So there's also that type of potential bubble effect. That's in the name. Atco was a great trade. It was a utility. I wasn't expecting to get 40% return on it in the year. This was just one. Basically, most utilities have this cost of service reimbursement kind of play with the regulators. So basically, whatever their cost is, they make a little bit of proceeds. It's called allowable ROE. ATCO also has allowable ROE, but it's based on a PBR, so performance-based cycle. And what that means, if ATCO does a good job, they get to keep some of it, and they have to give some of it back to the ratepayers, so the province of Alberta in this case. So what happened? Basically every 5 years, they have to actually, you see earnings growth slow down because they have to give some of their efficiency back to the ratepayers. That's the idea. So there's some alignment. So ATCO gets some of the profits, but then some of it has to be given back. And because they have to give it back every 5 years, because it's a 5-year cycle, that 5th year looks really bad because the earnings per share usually is either stagnant or decline. So all of a sudden you have a utility that's growing pretty steadily in earnings per share, and then every 5th year it gets hit. And whatever reason, the market, like, it's overreacted, I think, 3 out of the last 4 cycles. So it's very, like, 75% probability, right? It overreacts to earnings declines. Utility, it's very stable. We knew population growth was increasing in Alberta because we actually saw people from Ontario finally move here for the first time in a long time. So it was you had ratepayers increase, and you had a really easy comp. So because that period was last year, and then this year you're just going back to the 5-year cycle again. So it was just very easy in my mind. So that was a nice 40% return. I think that was about $5,000 gain. So that was a nice one, especially for something that's relatively lower risk, right? It helped balance out the portfolio a bit because it was very techy. AT&T was another great one. This one, it would be nice if the Canadian telcos could ever get this cheap. Like if Rogers got to 6 times earnings on some type of scare, it would make me very excited because that's what happened with AT&T. These US guys trade a lot cheaper than the Canadian telcos do, especially over the last 3 years. Now telcos have finally corrected. Like if we saw the channel last video, I talked about Rogers a little bit. That's the idea, is basically, and actually some of the proceeds from AT&T are going to Rogers. It's just AT&T during July, I think it was July or something in 2023. They had this like lead Wall Street Journal thing, blew it out of proportion, says all this cost. No one had a clue what it actually cost or what the damages might be, if any. And anyway, the thing sold off like crazy, and the thing was already putting up like 240 in earnings power, or 230. It said something over 2. And anyway, the stock was trading almost $12, so like six something times earnings. It was getting like an 8% dividend, so cheaper than ever. And the balance sheet was getting better because they actually have been paying down debt, and they sold off Warner Bros. Discovery, right? So they told us Time Warner to make Warner Bros. Discovery. But anyway, it was just it was finally looking better. The decisions are making better, and then you had the continued ARPU and ARPA growth, so average revenue per user. On the mobility side, you had net adds still increasing slowly over time with population, like we see with all the telcos, right? So it was a very easy buy in my mind, especially because at the same time in Canada, like TELUS was trading at 20 times earnings, so it was 3 times more expensive than AT&T, right? And Rogers was like 15. I don't know what they are now, but they're getting close to getting cheap, right? Probably under 10 times on a adjusted earnings basis. for Rogers now, which is cheaper than its relative average. Same with Bell, right? But again, part of that is because the market's likely forecasting conservative government in Canada. It probably means a harder stance on immigration, which means we're probably going to have less population growth, which should impact the net adds for the telcos, right? So that Rogers will probably be a slow, steady add over time. Though how quickly they've declined lately is exciting, right? At least from my point of view, to consider adding them. So I'm going to familiarize myself with Rogers more over time, just because I think they're the ones that actually grew EBITDA very well year over year because of the Shaw acquisition. So they've actually improved the business dramatically versus where they were, say, 10 years ago, even though the stock price is back to where it is 10 years ago. So that's the type of things that I like to look for. Maninso was another great trade. So this was a China trade. You can see buy here, $13. This one was actually a late one. So I saw China rally quite a bit in September, and Maninso didn't. It actually sold off, right? You can see, let's just see the timelines here. You can see how long some of these trades are, right? I start buying in January of last year, right? At 20, add again at 17 again, because I'm averaging in. And this is, you have to remember, at 16 when you're in at 20, it's not easy to do, right? Because you have to, like, what am I missing? Am I wrong? I'm down 20% or 10%, whatever the average would have been, right? And then all of a sudden you sell some, just a little bit, 2 shares, nothing. So really you're buying the whole time. And then you buy again at 14. So the thing gets hammered from 21 to 14. The whole Chinese market has rallied, and you're like, okay, that's weird. So you basically just average even more in with more size. And then 6 days later, you're buying more at 16.7 again. And that's how illiquid China markets is for underfollowed names. And Maninso is one that's growing extremely well over time, has a huge base of earnings outside of China. So it doesn't even rely on the Chinese economy as much as it's implied by the market, at least in my mind. It's just an easy growth story, and sometimes China gets silly valuations, especially when no one wants to buy it. So on earnings day, you can get these big swings in names, and you're like, that wasn't a big deal, and you can just buy it. And that's what you need to just wait for in China. So that was just that trade. It was just, why would this company that's at 19 all of a sudden shoot down to 14? The whole market's up like, I don't know, 80% or 100% in quick order for some of these names that we owned, right? Like Elixir Fintech, which is one I should have put on this list. Oh, there it is. Yeah, down there. But anyway, Suncor. This one, I finally sold the rest of it out. I've just seen a lot more favorable news for Suncor from a lot of fintech people and energy people, or FinTwit people on the energy side. All of a sudden, they're all excited for Suncor again. So now I can sell it. Now, I think, and this is just me, and I like playing the CNQ and CU or SU over and over again. And to be fair, the company still trades relatively cheap, pays a good dividend yield, has a good buyback yield. The debt's back down. Honestly, the whole space in Canada is really healthy in terms of the balance sheets. They've definitely cleaned up themselves quite well over the last 4 years. Now, what I think the market does, or the machines do, is whenever oil prices stay and AECO goes down, it likes Suncor more, and whenever both oil and nat gas is going up, it likes CNQ more. That's what I think, just because CNQ has a more they have more value on the revenue side, whereas for Suncor, AECO's nat gas is actually more of a cost input, whereas CNQ, because it also has drilling for nat gas, it gets some of the revenue side as well, so it has a natural hedge better when natural gas prices increase, and sometimes they increase usually at the same time. But last year they didn't actually. Oil held up a lot better than AECO did, and I rewarded Suncor for it. That's just my opinion. Now, they have finally executed better, to be fair, at Fort Hills, so it's not completely like Suncor just favorable because of commodity prices, but usually what I've seen is that I'm just better off to get out of it and then add to another energy company at some point when they're cheap again. And they're not expensive by any means, right? So there is a lot of value in energy. I mean, Vermilion was one, right, where I'm probably going to add again after the 30-day window, after I take my tax loss on it, just because there honestly wasn't a lot of losers this year. So like energy was one of the few places I could go to sell a loser as we went into year end. Elixir Fintech, so this is another Chinese one. This is one where like, and I did the video on this, like I was buying 1.7, right, and all of a sudden it shoots up to like $5, right? So it's like a free 200% return. It was screening dumb cheap. We could see the margins improve as the cost of financing. So basically, the Chinese government was basically allowing these guys to lend at even, like giving them better rates. And so you're seeing the margins expand, and the share price was just going down. I felt the market was penalizing them for going up quality. So basically, they decided to actually lend to less people, but lend to that same person more. So whoever was left was getting more borrowing. So it made technically the risk probably higher because you had less people to spread out the default risk. But to them, they said that they were actually going up quality. But it's hard to know if that's actually true or not because these numbers for China are always rough, especially for the smaller Chinese companies who don't give cash flow statements every quarter. But we did see the competitive guys start rallying and LX didn't. And so it's like, okay, what's happening here? And then you have finally some shareholder friendly results, right? They're going to pay back. I think it was like 20% of the net income. They're just going to buy back in shares, right? And the company is profitable and balance sheet was fine. So, it was just for my mind, it was an easy 200% return. I didn't know it would shoot up so quickly, but it was a nice trade anyway. And these things in China will happen again and again, especially with the less followed names. But again, you have the risk. And I mean, China-US tensions probably only going to get worse at some point, right? The market's probably price that in after 4 years, but you're still seeing like no one's there in China, right? When you're on the bid, like no one's there. You're like, oh, I held up the price today with like no dollar value. Anyway, so I just find there's lots of inefficiencies when I start turning over rocks in China. But the things can go very cheap, a lot cheaper. If you think value is going to save you, it won't. You need like something that's happening better in terms of rate of change. Like the cost of financing was improving, the quality was improving, and they finally had a better friendly shareholder buyback program, right? So there was something there that actually changed the performance, not just thing trades at 1 time's earnings. Or 6 times or whatever it was like 3 times. It's very cheap depending on what number you put in. And to be fair, they are harder to forecast, some of these small Chinese companies. Shopify, this one just rallied with tech in general. It seems to rally with the US market, so it's kind of like a way to have, in a way, US. I mean, it's a lot of small business Canada. The fundamental business is small business Canada. But for whatever reason, the share price correlates very well with US tech. So it's basically a way to get US tech exposure without having to buy US dollars because I already had so much. And it's appreciated so much, right? So I was kind of hesitant to buy more US dollars at this point in the cycle, especially when everyone agrees that the American market's the only one that's growing well, and especially Canada is probably going to slow even further next year if they actually get serious on immigration, because a lot of the GDP growth has been through immigration, right? It's been through just bringing more people in. You saw that per capita GDP number for the last 2 years in Canada, right? It's been very bad. So anyway, Shopify was just a way to pull that on. And the business is improving. It's never been cheap. This one was finally, I think it was still way cheaper than it was in 2021. It still wasn't cheap when I bought it at 80, right? 82 Canadian. I think it's at 140 now or 150. But so it's been a nice little trade since June. But I'm probably going to continue to trim it slowly. It's hard because you want to have decent exposure to Canadian tech, and Shopify is obviously the biggest one. And they did do some smart things. So one of the things I did like with Shopify is that they decided not to go the fulfillment route with the distribution centers and make themselves just a ride on basically e-commerce for small business in Canada. And then they kept cross-selling things very well. So Shop Pay and all that stuff, like helping the merchants with a lot more product offerings. I think we did a video on Shopify at some point, I think. But if not, I'll do one, because it is a very interesting company. It has the potential to be very big. It's never been cheap. It's never been like, oh my god, I have to buy it, right? It's just whatever people think it's worth today is what it's worth today. It's hard to pin on it, right? But if you want a small business, it's a pretty good software stack, and it rides, like I said, it will ride on the transaction margin of the small businesses. It will help the small businesses out with revenue and accounting. It helps with forex it just helps. So it's getting, and the product's getting better. So to be fair to Shopify, the product is better than it ever has been. So there is that as well. Expedia, this one was just travel, and this was a fun one. Expedia has been trading at like 6 times EV to EBITDA, and Booking just kept killing it. And so during, I'm pretty sure it was May, the thing shot back down. It shot down like 20% in a day or something, back down to like 112. I think it's around like 180 now. So this is when we bought some more. We sold it lately. Like I no longer own any of it. And we've seen the travel, like Booking and Expedia, do very well. We've seen Carnival do very well. We had like, and I follow all these companies. And the travel bookings on cruise lines are still like all-time highs, right? Consecutive all-time highs. So people want to cruise, and part of that I think is because the value for cruises is actually still really good relative to hotels. Like the prices for hotels have gone up more than cruises have. So in terms of travel expenses, it actually looks like a pretty good deal, especially if you buy a package. You're all in, food is included, right? You factor that into the food that you would have ate somewhere else if you were traveling. There's a lot of value, I'm trying to say, in cruise lines. And so anyway, you're seeing all these bookings, and that's why one of the reasons why I really like Airbnb is this, because it hasn't performed, and we know the whole industry's performed very well. We know the whole industry's taking price, and Airbnb rides on all of that when they put it on Airbnb. Like a hotel room on Airbnb, if the price goes up the hotel room, Airbnb gets more money. If prices go up for houses, Airbnb gets more money. It's just an inflation rider, 100%. And then you have the actual growth of the brand, and the 80% gross margins don't hurt, right? And then you're gonna have the scaled RCs. But anyway, the Expedia trade was basically just dumb valuation. You had the software stack for Expedia actually improve as well. They're doing a lot of good things, and we knew that the volume was there, right? We knew that people were traveling more than ever. So I was like, okay, I'm getting something at 6 times EBD, but what probably is worth 9 to 10, right? So that's just my opinion. I'll probably, if I get this cheap again, I'll probably go back in it. I just like this business model. It's very easy to understand. The financials are easy to understand. Celsius. So this one is going to be, I think it's on my good and bad. This is one I did a video around like, I want to say like 40 or 50. I can't remember. Anyway, it shot up to like 80. So I sold what I had just because it shot up and I was kind of afraid. So it turned out to be prudent. And part of that was me listening to myself and how hesitant I sounded on the video. And so I sold that position, and now I started adding back again under 30. Celsius is very interesting. So its earnings, like its whole financial, like its inventory turnover was amazing when Pepsi jumped on. The revenue growth shot up, the EPS shot up. You could start seeing scale. But now you have this overhang where Pepsi perhaps over inventoried itself for Celsius products. And we have seen a weaker energy drink market in general. Like we've seen Monster's share price actually go down year over year too, right? So there is that. And then you have things like Red Bull doing the sugar-free energy drinks as well, right? So you have a lot more of this sugar-free, healthier energy drink market growing quite well, where Celsius operates in, probably one of the best ones, especially for the female demographic. So again, this company, like it couldn't, like, it's $26. And maybe they do $1 in earnings this year, right? So 26 times earnings. But the thing is, if you look at the growth trajectory of what's possible, it could be very cheap. It just really depends on the market. Internationally, if we look at how they're performing on Amazon, if you see Amazon is like the most competitive market for energy drinks, which is not necessarily true, they are winning, right? So their product is resonating somewhere to some people somehow, and it's doing it relatively consistency when it's established itself. Right, and we saw it, like we saw as soon as it breaks into convenience stores, it just shoots it up, right? If all of a sudden they get mini fridges of Celsius instead of mini fridges of Red Bull, you see the sales improve, right? It's just if they can crack that Red Bull Monster duopoly, which, to be fair, this is the third biggest energy drink by quite a bit already, so it has done more than I think most people would expect. So there is something there. It's just hard to know how cheap I can get it. Like, how cheap is someone willing to sell me during this next, like, last quarter was horrible. The next quarter is probably not going to be great, right? So you have this overhang. So that means, do I have to wait? Do I have, like, basically, do I have 7 months to buy this thing, right? That's kind of where my head's at. Do I have 7 months to slowly average in? How cheap can someone sell it to me? And when does the thesis break? When is like, okay, obviously Celsius is having too much pressure from Red Bull and Monster, and they're just taking the share, and Celsius brand image got destroyed somehow. Maybe they do something wrong. Who knows, right? Anything can happen in CPG. I am surprised because Pepsi's also under pressure to grow, that they don't take more of an active position in this, just take out the market, right? I'd also protect their other things like Powerade and the Gatorade market have just been in decline since these energy drinks continue to take share, right? So that's something to look on. Like I would, if I was in charge of Pepsi, which I'm not, this is something that I would buy right now. Just take advantage of a pullback, partially because of what you did to the company, and just because it had the importance of Pepsi on the business, right? It's huge. So I just think that's something that's going to happen. But anyway, it's technically a good trade because I got out because I was like, well, it's shot up on nothing. And then I had people like DM me saying, why didn't you buy more at 50 or whatever it was? And I was like, oh, it's because the thing was trading at 50 times earnings and probably something that's rate of change deselling, right? So it turned a bit prudent, but at the time I was like, okay, obviously there's some type of little cult following for Celsius, so I was like, I better sell some. Because I was getting flack just for saying don't buy it at 50 times earnings when the thing was decelerating. So now that it got cut in half, actually more than that relative to when I was getting the DMs at 80, it looks pretty good. BlackRock, this one's really fun. So good trade. Really, there's certain companies like BlackRock that they always seem to get to 15 to 16 times earnings. So like say we'll see the beta in the market turn, BlackRock rides the beta of the market good. Basically it makes money on total assets under management, which go up and down with the market. So if the markets go up, they make more money. Markets go down, they make less money. And the scale shows up very easily in terms of EPS because you don't need to hire more people because the markets go up or down. But the markets go up over time, so BlackRock's always a good investment over time, or at least that's my opinion. And then you have the ETF side, which is just very misunderstood with the general public. A lot of people don't know the difference between a mutual fund and ETF. They're not taught this at all, and how crazy mutual fund fees are, especially in Canada. They're the worst in the world, right? And you can buy an ETF that does the same thing, charges you 10 bips versus 2%, so 200 bips, right? It's like a savings of 80 or 90%, and no one knows. Like the average Canadian doesn't, like especially the older demographic, they're all on mutual funds because they trust it. Like, I trust you to take 2% of your wealth each year. But anyway, it's just BlackRock just wins. So as more of money goes to ETFs, which it will, it has to. And you get a beta correction, that's when you just buy the hell out of it. So that's going to be my no-brainer whenever we have the next big recession and the stock markets come in. BlackRock's going to come in with it because it's a beta rider, and just buy the hell out of it. That's my game plan. I just wish I put more in at 15 and 16. The more I follow it each quarter, the more I'm like, Jesus, it's just sitting right in front of me. IMAX, so this one I'm still trimming. I might trim a bit more in early 25. It just went up 60% in a year, maybe a bit over a year. It's not as no-brainer. There's still probably one more quarter of easy comp, so I probably still have 3 months or 4 months, but I have started trimming it around the $25 range. It's just been a really good trade. A part of that was because the overhang of production from the strike for movies. So we've seen the quantity of movies come back. We've seen the reliance I talked about this in the last video, where the director Christopher Nolan for Oppenheimer basically thanked IMAX's opening statement when he won the Oscars. So it's just IMAX in terms of where it sits in terms of filmmaking, it's the best one, and I think it will continue to take share and continue to grow well around the world. And it also has a better business model. It does ride on box office numbers, but it's not the whole thing. There's a big maintenance component there with the shares, with the exhibitors, and the exhibitors are all around the world. It's a very global company, so I do like IMAX longer term. It's just when something shoots up 60%, obviously the idea got worse, or it got more priced in. It's not as easier as a no-brainer as it was at $15, right? Or $14. Spotify, this one, I finally started trim. I might trim a little bit more. You can see here, and this is another good idea of kind of how I trade things, right? So again, I'll start buying something. This is 2 years ago, July 2022. I buy it. I'm pretty sure there was Investor Day around here, which gave me more confidence, but I'll buy a little bit at 113, buy a little bit more at 103, buy more at 93, buy more at 73, right? And that's just in 4 months that things gone from 113 to 73, right? And I see it fluctuate. Buy some more, wait some more, buy some more. I'm just getting more information, getting more confident. And that's kind of how I do it. And then it goes to 140, so it doubles, right? So I sell 5, right? Or sell a little bit. And then it goes up all of a sudden to 480, so I sell a little bit more, and that was around November. Now, I would have sold more here. It's just I I'm trying to be tactical with my capital gains this year, so I'm delaying that. So this is something I'm probably going to trim a couple more shares in early, probably, I mean, what is it now? December 29th. So probably December 31st. So it toggles it into the next year when it settles on January 2nd. So that the taxable gain goes to next year because it's in my taxable account. So that's just how I do things. I try to manage the taxable impact of all these capital gains because there have been a lot more gains the last 2 years than there have been losses. And some of these like I am reading some of the comments, but some of these are for me, right? Remember, don't time the bottom, just be nimble and add if believe. It would be nice if we had a tracker for investor days for large companies, because I do find them to be very informative for me, like what's actually true. Like they all have a story, right? A storyboard, but you can kind of see if you think they can do what they say. And I think investor day just gives you so much more information in terms of what the management team is thinking. So I do wish I had a tracker for investor days. So if anyone knows like a platform that tracks like upcoming investor days, I would love that. Because that was one of the reasons why I made 400% on Spotify, right? And you could tell the questions at the time, like none of the analysts were like, "Are margins actually going to improve?" And it's like, yeah, we're raising prices for the first time ever, and podcasts are no longer going to be margin dilutive because of the scale's finally there. So you had the music business just going to finally improve margin because they actually taking price. And to be fair, they were actually scaling underneath the surface just because of the size and the users. But it was hidden because of their investments in podcasts. So the whole time for like the prior 5 years, the business is technically getting better. It just never showed up in terms of margins because they're investing into the next platform, which was podcasts at the time, right? So it was kind of funny to piece that out, right? And it helps you hear like what the analysts are thinking because that's the consensus, right? That's what they all think. That's what they all publish. That's what they post to all the bankers all around the world. All the portfolio managers all read that, right? So if you could start thinking for yourself and be like, okay, that's what they think, this is what I think, and is it likely to happen? And that's why I think sometimes you get very nice disconnects like that, especially for a company like Spotify, right? And I find software companies can be mispriced for quite some time because the scale isn't fully understood. It's not linear. It can be flat, exponential, flat, exponential. It depends what they're doing, right? And I do think the investment into podcasts was hiding the scale that was in the model. And then on top of that, you finally had them take price, which obviously helped the revenue growth and the margins. So you had both things at once, which is probably why it amplified the gain. But anyway, those are the winners. Jesus, what time is it? 32 minutes in filming before editing. Okay, Vale is a bad one. So this is Brazil iron ore. I had a price of mine at $10 or less for Vale in 24, but I decided to first buy at 11.5, and I bought in basically all the way to 10, averaged in, and then I sold some at the end of this year just because for tax loss reasons. Iron ore prices will be weak for longer. It's always hard with commodities. I'll probably buy it again in 25. The balance sheet's fine. The dividend yield's amazing. There is a lack of policy support in Brazil. The whole Brazilian market's actually sold off with Trump being elected, which is interesting. But and the same thing with Stone, another Brazil company, which I trimmed. Actually has a gain still, but I should have took more out. This was me sleeping on the interest rate cycle. So the whole reason when I went to my old video, I could see my eyes get excited when we saw inflation peak because we knew interest rates were going to peak. And that helps the margin for Stone's core business. Basically, they borrow from a floater. So as rates got higher, their margins on their lending got weaker, depending on the rate of change of the interest rate cycle. And as interest rates started going down, like they were the last 2 years, we actually saw the margins expand again. So Stone actually did okay. But the last quarter and the quarter before, they actually said that interest rates were likely to go back up again. So inflation was going to restart up, which is not great for a company that basically borrows from a floater and then relends at whatever rates they can negotiate. So basically, they do renegotiate with the merchants. It just takes time, so they get squeezed in the short term. And I should have been more active on that. But it is, again, the company has been performing very well. So is Vale. So it's like they're both performing very well. They're both very cheap, and they're both Brazil. Two totally different business models, which tells you that there's probably value in Brazil right now, right? It's just what do I sell to go there? So I probably will be buying one of these in early 24. or 25. Baidu, so it's another China one. So we're doing a lot of emerging market bad plays, but honestly, these are all the ones that didn't work. Baidu, I was trying to bottom fish it, right? Buy 3 at 97. I remember looking at it under 100, getting excited. I think it's around 80 now. I should have done more work on the offerings, especially when you compare like the whole value set in China is cheap. So why Baidu over Baba or Tencent, right? Because we were very successful with Tencent. We weren't successful with Baba or Baidu. So it's just why understanding like, is Baidu actually that weak? Why are all their businesses so unable to execute, right? Like, why is their Netflix not that great? Why is their offerings not that great? Why aren't they able to monetize EarningBot more? There's a lot of things like, why aren't you getting results when you're in a position to get results? To be fair, they could be starting to get results, but it's just hard to know. And then you have the opportunity set, right? So right now, did the last video, you saw him in JD. I decided to go with JD instead of Baidu for now, just because JD is executing, and latest calls from all the Chinese companies, they all said, this includes Pinduoduo, they basically all said that appliances and electronics were doing well, which is where JD's bread and butter is. So I finally have at least not weakening consumer demand, which has been true in China for quite some time. We finally have something stabilized where actually some of the things that JD scales into is actually doing better, right? And the price is still dumb cheap. Not crazy cheap, but for cheap relative to the opportunity set that's available to me. Jack specific. So this is one. I was trying to get cute with the timing. I remember thinking about it. Basically, I wanted to walk away and revisit in the winter of this year, so winter 24. So I sold it all, and I sold it all what appears to be near the low of the year. So that kind of hurts, especially because I'm buying it now at 26 and 25, right? So I'm buying more of it as we speak. And part of that, I thought that I could get back in early winter 24, right into the Moana and right into Sonic. But the market front run me. Toys in general did better, I think, which also screwed up the timing relative to last year. So I should have been thinking about the macro toy market as well, because the last year's 2023 toy market was pretty weak. The film slate was super weak. So I think the market also front run me quite a bit by probably 3 more months than what I thought I had. So that kind of sucks. And to be fair to Jack, they did everything right with the like their inventory management's been better, their balance sheet management's been better. Right, the whole debt profile got better. So I perhaps should have tried not to be as cute here. But that's the name of the game. Bumble. This one, I like when I listen to myself on the video, right? I'm buying here at $11, buying here again at $11. When I listen to myself though, it's like, don't buy business models you don't like, right? So if Bumble is great at matchmaking, it gets better, then people won't return because they're literally gone off the dating platform, right? So the business naturally has a churn that challenges the scale. So the better the product gets, the more likely, the less people are going to use it for a long period of time, right? So, and to be fair to the investment thesis, they were cost cutting, and the value was potentially there. Like the thing got shellacked from like $80 to $10, right? So it was on sale. It's just, are you confident enough to keep buying as it gets cheaper? Because the business is you don't like longer term, right? Especially relative to other things that are in the market. So that was a hard one for me to let go of. But I think it was prudent. And then Tidewater, this is probably my worst trade of 2024. Pretty sure I lost about $9,000. This one was me probably trusting management too much rose-colored glasses. At the same time, the business was constantly over budget, both in cost and time, constantly over promising and under delivering, and kept giving them the benefit of the doubt. It did screen very cheap if what they said would work out, but it didn't. And at the same time, by the time they got things in production, the whole market for LCFS, the whole market for the credits for renewable energy just got dumped on. So like by the time they finally got it up, the economics of the business just got crapped. So they had weak management, over-promising management, inability to execute, and it was there for a year. So I should have picked up on this sometimes I just get stubborn, or I anchor on value or hope, right? And this one should have just been like, why wait? I bet you I can just, like, should have just sold it and then see, like, when do they actually get it up and running and see what the economics are at that time. And that's my bad. So that's something that sucks. And honestly, that usually doesn't, when it's going to happen, it's going to happen. Energy prices, so energy market. So you not only do you have a risk of commodities, but you also have a risk of execution. So you don't know when the product's going to finally come online, and if they're going to do it on time and on budget. And when it finally gets online, what's the market going to be like for it, right? So you had these two risks that confounded each other. Both were bad, and then you had a consistent poor execution. So, and that's something I should have been like, you know what? If you're going to under execute, I'm just going to leave for now and revisit once you guys finally get what I need for this investment to work up and running. Now, to be fair, it could be very cheap right now. I've tried to go back into companies like this before, and I can't do it because I don't have the trust of the management team. I just, like, why? You just eviscerated my money, right? Like, you can see this here. I bought 500 at 0.65. I'm pretty sure Tidewater's at 13 cents right now. Like, that's how bad it was. And I thought I was getting a deal because it went from $1 to 55 cents, or even more than that. So it's just sometimes things are getting cheap for a reason, and it's sometimes people know things ahead of time. And I think somebody probably knew that Tidewater was not going to do what they said they would do. And I should have just said, well, you're obviously unable to execute, because they technically never did. They kept just pushing out timelines and budgets. So, and just putting a big EBITDA number in front of me. And I was like, oh, if they get this, then it's going to work out. And then they just kept pushing the carrot down the road. But anyway, those are probably the best and worst trades, like, in terms of value. I'm pretty sure I lost like 3K in Vail. Most of these, I think Stone Eye was still up by the time I walked away. Baidu, I think that was like a 1K thing. This one just opportunity cost, right? Because now I have to I'm buying back at 26. Bumble, I think, was a 2K loss. But yeah, the Tidewater one was the one that hurt the most, like 10K or something. But I mean, all these ones offset it. But losses happen. The main thing is to try to learn, right? And most of my time is trust team management instead of being able to think for myself. And I tend to be optimistic. So when, like, especially during investor days, I'm going to look at them and be like, is that true? But I need to be like, can they execute it? What are the risks, right? And I find smaller companies actually are more likely to be over budget, both in time and cost. They just don't have the discipline or the expectations, or maybe they don't have the ability to communicate as clearly to investors, right? They are getting paid a lot less. So it's something that maybe I should have screened harder for and been like, what could have went wrong? But these things happen in investing, and you just kind of roll with it and try to learn. But yeah, I like these videos because it kind of shows me what happened in 24, because it'll be fun for me to revisit this later and be like, okay, I remember that trade, I remember doing that. It's just kind of fun. I just tried to pick the ones that I knew that I sold this year that did well or did very poorly, and those are the ones that came to my mind. But anyway, hope you guys have a great New Year's, and I'll see you in 2025.